Are you considering buying a home? Congratulations, you're watching the right video. So buying a home is a very, very exciting journey. I would say it's probably one of the best things that I've personally gone through, and it's actually changed my life buying my first home that was $75,000. However, it can be very confusing when it comes to the interest rates. So in this video, we're going to talk about how to look for the interest rate and how to navigate the constant fluctuation in the interest rate when you're going through the home buying process. I have a conversation with customers every single day about locking in interest rates. And when locking in interest rates, I think the best way to really kind of like look at this is, hey, if we lock in your interest rate and you're happy with the payment and the rate, you should go ahead and lock it in right away. However, if you're uncertain and you want to float it to see how the market goes, or hey, I know the Fed's going to meet in a couple weeks and I want to float until that point, you're basically gambling, right? And how often do the interest rates change? And as a consumer, you probably don't know as much unless you're constantly emailing your loan officer every hour to see, hey, how are rates right now? How are rates today? How are rates this week? How are rates for the month? So on and so forth. However, it can get very frustrating when you're doing that, because you're going to see, oh my gosh, why are rates changing? So I'm going to show you how to keep an eye on this. So one of the best things to do is just know with interest rates, they are going to move along with the bond market. When it moves with the bond market, it's just like the stock market. So every day on Wall Street, the opening bell is at 9:30 or 9 o'clock. And when that opening bell sounds, that means the markets are open and off and running. However, there's pre-market and post-market trading. The same thing happens on the bond market. When our pricing comes out at around 10 to 11 o'clock, these investors that were putting the loans through have a secondary market and a really good analytics team that handles the economic ramifications of any interest rates that are being offered. And they say, hey, based on today's interest rates and what happened in the first couple hours before we priced, we are going to set our price at this amount, okay, for every single one of these rates. And typically the rates are going to be in 1/8 increments. The fluctuation can actually happen almost every single day, and sometimes every hour, every 20 minutes. When COVID first hit, I'll never forget, I was in my office, I was working, and all of a sudden I get a phone call from another one of my coworkers, and he was like, I just do not know how we can sell these interest rates anymore. We went from 3 to 4% interest rates overnight to like a 1.5% spike immediately, right? And when that happened, that was all happening while all this COVID data was coming out. That leads me to the next point, the type of factors that can affect the interest rate. Factor one is going to be inflation. We're going through inflation right now. There's no mystery about that. And with inflation, that means the cost of goods are going up. And the dollar is going down in value. And that data typically comes out, every couple weeks, and that inflation data definitely affects the bond market. Employment rates. Employment rates are very, very crucial to, interest rates as well. And that data, once again, comes out, every week. There's multiple forms of data that come out. With that, based on the employment levels, that kind of gauges how the housing market's going to be. And based on the housing market and the employment rates, that really goes hand in hand with the affordability and how many homes kind of like are being paid on time and how many homes are going into foreclosure or default or anything like that. And that definitely affects the lender's portfolio. Government policy changes also affect interest rates. With government policy changes, change in administration, change in government, governor races or mayor races, factors that happen outside of our control, such as 9/11 or any type of like earthquake, natural disasters. Those typically affect interest rates as well. And it typically follows suit. So as soon as that data hits, that investor is scrambling, right? Certain investors price it right away as soon as that information hits. Some price it in a couple days in advance, and some may be behind. And those are the ones that, if we notice that change is happening, I'm immediately on the phone with my consumer saying, hey, this is happening. I'm seeing certain investors reprice for the worst. Their pricing's expired. So there's 3 investors right now that are available with their interest rates super low right now. So we need to go ahead and potentially look at locking in. We choose a rate, and after we chose that rate, and you want to discuss it with your family, if you decide that you want to go with a higher or lower interest rate, we can go to that, back to that same day rate sheet and kind of check the rate for you. With interest rate, they're not all going to be the same. You have your retail banks, you have your retail correspondent lenders, you have your direct lenders, and those are going to be the ones that have the loan officer and a lot of middle level management, right? And that helps, right? You know, it helps because you could kind of like all in one box kind of talk to that person. And I used to do this for many years as a banker as well as a retail correspondent lender. But with that being said, you know, I think that, you know, you should definitely also consider wholesale mortgage brokers. With a wholesale mortgage broker, there's not a lot of middle level management, so your pricing's typically going to be way lower. And based on 22 HMDA data, an average consumer can save between $8,400 to $10,400 when getting a loan through a wholesale mortgage broker. With a wholesale mortgage broker, the way that we do things is, like I said, we have a lot of different options, right? So when we price it with that one investor, we're going to say, okay, I'm going to send your loan to ABC Mortgage. ABC Mortgage has an account executive that is typically a retired loan officer or a retired underwriter or a retired processor, someone that's in the mortgage industry that understands it, and they can tell us what are the potential challenges in your loan up front, right? We also utilize their underwriters and sometimes their processors as well. But we just go out there and we shop it for you without the help of like middle level management or corporate structure. And because of that, you will save more. How often does it change? I will say that several times a day, I'm seeing like rate changes. During lulls, like summer breaks or winter breaks, you're gonna have a lot less people in the bond market, so way less volatility during those times. However, during the regular times, you know, economic data is literally coming out almost daily. And then you have news and everything that happens daily. It definitely occurs several times a day. Sometimes once a day. Sometimes rates will come out and it'll be good for the entire day. And sometimes it can even change, like, you know, every like 2 or 3 days at a time. If there's no economic data, nothing changed, and no reason to believe that anything's going to change. I would highly recommend that as soon as you find that rate that you're interested in, I would definitely go ahead and lock in on it. The website that I personally use is Barry Habib's MBS Highway. However, as a consumer, you can definitely go into things like mortgagenewsdaily.com. That's a great site. It tells you what the rates are trending at, and whether they're up or down or a reprice is getting ready to come. I would definitely, if I'm going through the home buying process, I would definitely subscribe to that. And then you can cancel your membership once you, kind of find and narrow down your home. Factors to kind of consider when getting your interest rate is credit score. Even if you have poor credit, I wouldn't just go to one lender and, they say, hey, we can't do it. And then next thing you know, you stop shopping for a home. As a matter of fact, today I got a call from one of my realtors, and they said, hey, I have this veteran borrower, and he was turned down because he had a 609 credit score with this investor. She was like, he doesn't think he can get things done, but can you work with this credit score? Immediately, I was like, yes, we can definitely work on it because we're the world's largest wholesale mortgage broker. So we have investors that'll go down to a 500 credit score on a VA loan, where most of your typical lenders, banks, and correspondent lenders are going to stop you at 600, 620, 640, 660. So it's really important that you kind of, keep an eye on your credit score. Look at the different factors that can change your credit, such as utilization of your credit, the type of credit, the inquiries, and other factors that will affect it. Then we have your down payment. The more you put down, there's a minimum down payment on every single different type of loan product. FHA is 3.5%, VA is no money down, USDA is a minimum of no money down, and then conventional is as little as 3%. When you put more money down, especially on conventional, the more money you put down, typically that's going to lead to a better interest rate, for the exception of 20%. 20% has typically one of the highest loan level pricing adjustments. So if you move it to the 85 or even 75% down, that typically helps out a little more when picking your interest rate. Loan term definitely plays a critical role, okay? So 15 or 30 year. 15 is always gonna be a lower interest rate. 30 year is going to be in the same bucket as a 20 year and a 25 year. So the longer the term is stretched out, typically it's going to be a higher interest rate because the investor has to hold your loan a little longer to make that monthly more interest. Whereas a shorter term, they're making less, but they're also giving you a better interest rate to go with a 15-year term. However, I think the downside on getting a 15-year mortgage is you're going to eat up more of your debt to income ratio. So if you go out and you want to, buy other things such as automobiles and get credit cards and things like that, every lending institution looks at utilization of credit and your debt to income ratio to determine the interest rate for future things. You may save on your mortgage, but you may pay more on other things if you take that 15-year mortgage. In conclusion, I think it's very, very important to understand the interest rate fluctuations when you're buying a home, and it can certainly feel daunting. But with the right information and guidance and a clear line of communication with your loan officer, you can easily navigate any aspect of the home buying journey successfully. Stay informed, consult with your professional, make an informed decision, and good luck on your home buying adventure. Thank you for watching this video. My name is David Xie with the Xie Mortgage Team. I can be reached at 757-478-8493 or click on the link below to schedule a time on my calendar that I'm available. And if you found this information helpful, don't forget to subscribe to our channel for more valuable insights, tips, and happy home buying. Bye.